Welcome to Top 10, the home of rapid-fire rankings. From fascinating facts to the freshest trends, we unveil the best of the best, all in a bite-sized package. Immerse yourself in a world where less is more, and seconds count. Stay curious, stay engaged, and remember, life is always surprising when you're counting down with Top 10.
Hey everyone, it's B, and today we're diving deep into the world of mortgage rates. Specifically, how to position yourself to win big when rates inevitably come down. See, mortgage rates don't just sit still, they fluctuate up and down based on a bunch of factors. Kind of like the stock market. Things like inflation, the Federal Reserve's decisions, and even the overall health of the economy can cause these rates to bounce around. But here's the good news. Understanding these factors and knowing when and how to strike can save you tens of thousands of dollars over the life of your loan. And that's what we're going to break down today. We'll cover everything from the current economic climate to historical trends, government policies, and even how to boost your credit score to qualify for those super low rates. By the end of this video, you'll be armed with the knowledge you need to make smart, informed decisions about your mortgage and potentially save a ton of money. So buckle up, hit that subscribe button, and let's get started. All right, first things first, let's understand what's driving mortgage rates in today's market. Because honestly, it's a wild time out there. We've got inflation still sticking around like that one friend who never wants to leave the party, the Federal Reserve raising interest rates like it's going out of style, and a whole lot of uncertainty about the future of the economy. So what does this mean for you as a potential homebuyer or someone looking to refinance? Well, it means understanding these economic indicators is absolutely crucial, because they're the key to predicting where rates might be headed next. For example, if inflation starts to cool down, we could potentially see mortgage rates follow suit. On the other hand, if the economy takes a turn for the worse, rates could actually go up as lenders become more cautious. The point is, staying informed about these factors is like having a crystal ball for your mortgage. It allows you to anticipate changes and make the most strategic moves with your money. And don't worry, we'll dive deeper into each of these factors in the coming chapters, so you can really wrap your head around what's going on. Now let's take a trip down memory lane and look at how mortgage rates have behaved in the past. Because believe it or not, history often repeats itself, especially when it comes to finance. Remember those super low rates we saw back in the early 2010s? Yeah, those were the days. But it's important to understand why they were so low and what caused them to eventually rise again. See, after the 2008 financial crisis, the Federal Reserve stepped in with a bunch of measures to stimulate the economy, including slashing interest rates to historic lows. This, in turn, pushed down mortgage rates, making it incredibly affordable for people to buy homes. However, as the economy recovered and inflation started to creep back up, those rates began to climb as well. And that's a pattern we've seen time and time again throughout history. The takeaway here: mortgage rates are cyclical. They go up, they go down, and understanding these historical trends can give you a huge advantage when it comes to timing your moves. Okay, this chapter gets a little bit political, but stick with me because it directly affects your wallet. Government policies, whether we like it or not, have a massive impact on mortgage rates. For example, remember those super low rates we talked about earlier? Well, those were heavily influenced by government programs designed to boost the housing market after the 2008 crash. And it's not just the federal government either. State and local governments can also implement policies that affect things like property taxes, housing regulations, and even lending practices, all of which can trickle down to influence mortgage rates. The key here is to stay informed about any upcoming legislation or policy changes that could impact the housing market, because these changes can create opportunities for savvy borrowers to snag a lower rate or refinance at the perfect time. Chapter 4. Why inflation is the silent killer of your mortgage. Inflation. It's the word on everyone's minds these days, and for good reason. It's eating away at our purchasing power and making everything more expensive, including, you guessed it, mortgages. See, when inflation is high, lenders have to charge higher interest rates to offset the decreasing value of the money they're lending out. It's like a game of catch-up, and unfortunately, borrowers are the ones who usually end up paying the price. So, how can you protect yourself from this inflation monster? Well, one strategy is to try and lock in a fixed-rate mortgage when rates are relatively low. This way, even if inflation goes up in the future, your monthly payments will stay the same. Another tactic is to consider making a larger down payment if you can afford it. This reduces the amount of money you need to borrow, which in turn reduces the impact of interest rate hikes. Remember, inflation is a fact of life, but it doesn't have to completely derail your homeownership dreams. Chapter 5. The Federal Reserve, friend or foe to your mortgage. All right, let's talk about the big dog in the room when it comes to interest rates, the Federal Reserve. Now, the Fed might seem like this mysterious entity that controls the financial universe, but understanding its role is crucial for anyone looking to buy a home or refinance. Basically, the Fed sets the tone for interest rates across the board, including mortgage rates. When the Fed raises its benchmark interest rate, known as the federal funds rate, it becomes more expensive for banks to borrow money, and they pass those costs on to consumers in the form of higher mortgage rates. On the flip side, when the Fed lowers interest rates, it becomes cheaper for banks to borrow, and those savings are, hopefully, passed down to borrowers in the form of lower mortgage rates. So, what does this mean for you? Well, it means paying close attention to the Fed's announcements and policy decisions can give you valuable insights into where mortgage rates might be headed. Chapter 6. Locking in your rate. Is it the right move? All right, so you're ready to buy a home or refinance your existing mortgage, but you're not sure if you should lock in your interest rate or wait and see if rates go down even further. It's a tough decision, and unfortunately, there's no one-size-fits-all answer. Locking in your rate basically means securing a specific interest rate for a certain period, typically 30 to 90 days. This protects you from any potential rate increases during that time frame. However, if rates happen to drop after you've locked, you're stuck with the higher rate. On the other hand, if you don't lock and rates go up, you'll end up paying a higher rate anyway. It's a gamble, and the best decision for you depends on your individual circumstances, risk tolerance, and how long you're willing to wait. Chapter 7. Refinancing, your secret weapon for lower payments. Refinancing your mortgage is like hitting the reset button on your loan. It allows you to swap out your existing mortgage for a new one with potentially better terms, including a lower interest rate. Now, refinancing isn't free. There are closing costs involved, just like when you first bought your home. However, if you can snag a significantly lower interest rate, the savings on your monthly payments could outweigh those upfront costs over time. But here's the thing, refinancing makes the most sense when you can secure an interest rate that's at least 1% lower than your current rate. Otherwise, the savings might be negligible and not worth the hassle of going through the refinancing process. We all love a good deal, and it's tempting to hold out for the absolute lowest mortgage rate possible. But here's the thing. Trying to time the market perfectly is like trying to catch a falling knife. It's risky, and you could end up getting burned. While mortgage rates might drop in the future, there's also a chance they could go up. And if you keep waiting for the perfect rate, you could miss out on opportunities to buy your dream home or lock in a still favorable rate. Plus, remember those economic factors we talked about earlier? They can change quickly and unexpectedly, making it nearly impossible to predict when rates will hit their lowest point. Your credit score is like a report card for your financial health. It tells lenders how responsible you are with borrowing and repaying money. And when it comes to mortgages, a higher credit score can be your golden ticket to snagging a lower interest rate. Think of it this way. Lenders see borrowers with excellent credit as less risky, and they're willing to reward that lower risk with more favorable loan terms. So, how can you boost your credit score before applying for a mortgage? Start by paying all your bills on time, every time. This shows lenders you're reliable and can handle your financial obligations. Next, try to pay down your credit card balances as much as possible. This improves your credit utilization ratio, which is a major factor in determining your score. Taking advantage of lower mortgage rates isn't just about saving money in the short term, it's about setting yourself up for long-term financial success. When you secure a lower interest rate, you're reducing the overall cost of your loan, which means you'll pay less interest over the life of your mortgage. And that, my friends, is huge. That extra money in your pocket can be used to achieve your other financial goals, whether it's investing for retirement, saving for your kids' education, or simply having more breathing room in your budget. So, as you navigate the world of mortgages, Remember that even a small difference in interest rates can have a significant impact on your long-term financial well-being. There you have it, folks. The ins and outs of mortgage rate cuts and how to position yourself to win big. Remember, knowledge is power, especially when it comes to your finances. By understanding the factors that influence mortgage rates, you can make informed decisions that align with your financial goals. And hey, while you're here, hit that like button and subscribe to the channel for more finance tips and tricks. Because let's be real, who doesn't love saving money? Until next time, stay informed, stay proactive, and keep crushing those financial goals.
Thanks for watching Top 10 Countdowns. Desire more? Glide your cursor to the subscribe button, give it a click. Don't forget that notification bell. It's your golden ticket to our world of riveting Top 10 Countdowns. See you soon in the next video.